Hello again, traders. Doing here once again from DRFX, Swing Trading Mentoring. Going to be taking a look at a recent trade that was made on the pound Japanese yen, where we traded a false consolidation breakout reversal that was taking place on the 4-hour chart of this currency pair. So I'm going to be taking a look at the main factors that supported this trade to show you that once you're able to trade on the daily chart on the 4-hour chart using the right trading tools, then you'll be able to capture these types of trading gains that we captured here on this currency pair on a more consistent basis for strong trading gains over both the short term as well as over the long term. Now, this was a trading summary for the trade result that we got on the pound Japanese yen, where as you can see on my live account that I have here with FX Pro, this trade provided a trading gain of 60 pips, which represented a rate of return of 3.3%. And this trade took a very short time to hit the trading target, providing us with this trading gain in just over 7 hours. So this was well within the 24-hour holding period that I have as a maximum for trades like these that take place on a 4-hour chart. And the 60 pip trading gain was well within the range of 50 to 70 pips, which is the trading range in terms of the average trading target that I have for the trading methodology that I use. Now, in taking a look at this trade, we're going to be solving these 5 main factors and challenges that face us as retail traders every week. First up is that we have to ensure that we're trading the right setup and that we accurately identify what is taking place on the time frame and the currency pair that we're trading on. We also have to ensure that the signal that is given is the best signal and the strongest signal for the setup that we're trading, so that we can avoid the trap that comes with trading signals that are too weak. Also, in terms of stop losses, very important to determine whether or not the stop loss that we're using is strong enough that will allow us to stay in the trade and withstand temporary pullbacks until our trading target has been hit. Also very important that when it comes to trading within consolidation, that we make a distinction in terms of where we exit our trades. In most cases, when it comes to trading within consolidation, exiting your trades at support and resistance is usually the best bet. But depending on the setup and depending on the signal that is being given by the chart, sometimes you'll find that the market will actually come close to hitting the target and then pull back to head back inside of the consolidation, head back in the opposite direction without actually hitting the support or resistance boundary. So this can create problems if your target was set at the support and resistance boundary, but the market pulled back without hitting your target, causing you to incur an unexpected trading loss. Also very important is that you establish that the trading target that you're aiming for the trade setup that you're trading is within the established trading range that you have for your trading setup. So as I said before, 50 to 70 pips is the targeted pip range for all of my trades. And so this was the target that was set for this trading setup as well. Also very important to establish a holding period so that you know that in most cases your trade is going to be hit within a specific holding period, because you do not want to be trading and be holding out for a trading outcome when the market is unexpectedly slow, which would cause you to incur unexpected losses as the market reverses because you're holding on to the trade for too long. So with every trading methodology, you have to establish a specific holding period within which most of your trades are expected to be closed, and that you have the discipline to close that trade if the market has not yet hit that target within that holding period. So you're going to be seeing throughout the explanation of this trade how these 5 challenges and 5 factors were actually solved in providing us with this trading gain that we captured on the pound Japanese yen. Now, the setup that was traded is known as a false consolidation breakout reversal, which is where the market will break out at one end of a consolidation setup and then reverse, taking us back inside of the consolidation. And in most cases, it will break out at the other end of the consolidation. But sometimes you will have the market continue to move within the consolidation boundary. So that is why when we're trading false consolidation breakup reversals, my recommendation is to exit the trade at the boundary that we're heading back towards, because of the possibility that the market could continue to move within consolidation instead of breaking out at the other end of the consolidation. So this is the theory behind false consolidation breakup reversals. The market will attempt a breakout at one end of the consolidation, and for whatever reason that breakout will fail. Sometimes it has to do with a weak signal that was given, or because we were close to a major support or resistance point, and so the market did not have enough momentum to actually follow through with the breakout. So once the market starts to head back inside of the consolidation and it gives us a strong enough signal to indicate the start of the reversal, then we can take advantage of it and capture a trading gain as the market heads back inside of the consolidation. Now, in terms of the signals that you will see that the market will provide to indicate the start of a false consolidation breakup reversal, you will see several of them across the currency market, but the most common ones that you will see that provide the best chance of a successful trade are double tops and double bottoms, ABC signals, as well as bullish and bearish engulfing candlestick formations. These tend to be the ones that you will see more frequently associated with false consolidation breakup reversals. And so once any of these signals appear to start a false breakup reversal, once the signal is strong enough, then it has a high chance of actually leading to a profitable trading opportunity. Now, the signal that was given in this case for the pound Japanese yen was an ABC signal, which I would say is probably the most common signal that you will see when it comes to reversals, generally speaking, across the market, and specifically when it comes to false consolidation breakup reversals. Now, in terms of the trading platforms that I actually use two trading platforms to do my analysis and trading. FXCM is used to identify market direction based on the New York close of the daily candlestick signal, which is crucial to trading methodologies such as mine that are based on Japanese candlestick signals. So I find that this platform provides the best charting and the clearest chart in terms of analysis for the methodology that we're using. However, when it comes to actually executing my trades on a live account, I actually prefer to use FX Pro. So the demo account on FXCM is used to identify market direction and to analyze what is taking place in the market. However, I actually execute my trades on FX Pro for two main reasons. The first is that you can actually receive an email alert that tells you when the trade has been closed, which helps to avoid the self-sabotaging behavior that is associated with monitoring your trades. The second reason is that you can actually see the risk and reward values for an upcoming trade in percentage values, which ensures that you're able to stick within the risk to reward ratio that you have established for your trading methodology. Trading is done nevertheless on both platforms to mainly show you that there's no real difference between the trading outcome that you get on a demo account and the trading outcome that you get on a live account, so long as you use the same methodology and that you follow the rules for this methodology. Now, this was a setup on the 4-hour chart for the pound Japanese yen, where we had identified that the market had formed this range consolidation setup and was about to start a false breakout reversal with this strong ABC reversal signal. Now, in terms of drawing and identifying the market setup for this trade, the resistance boundary was drawn and identified to be best represented by this line here that was drawn across the highs, which I include the wicks of these candles, which I think is the best representation of these consolidation lines. So this was a line that was best representing what was taking place at the resistance area, and the complementing support line was drawn like this, where you can see that there was a little bit of a distance between the low here of this week and the low here of this week. So what is done is to basically draw a line that is midway between the distance between these two low points. So this was the best and accurate representation of the range setup on this currency pair on this time frame. And as you can see here, the market attempted to start a breakout bullish. But as you can see here, this did not last very long, and the market reversed sharply initially with this bearish engulfing candlestick formation, which was the first indication that the market was going to be struggling to start the breakout bullish. Now, the confirmation of this reversal came in the form of this U-turn, with the market closing with a strong bearish signal that completed the formation of this ABC reversal signal. So it was very likely that the market was going to be heading back inside of the consolidation, or continue to move back inside of the consolidation, heading towards the support boundary, which is the first main target when it comes to false consolidation breakout reversals. This was a signal, ABC signal, as I mentioned before, and how we trade this ABC signal is as follows. When the market has completed the formation of the U-turn that completes the signal here, the stop loss is placed above the C to protect the trade. So in most cases, as long as the ABC signal is strong enough, the stop loss would be safely placed at this area here, and will protect our trade against temporary pullbacks until our trading target has been hit. So this was a setup. This was expected movement of the currency as it continued to move back inside the consolidation, where it was expected to take us back down to the support boundary. This was a setup where the stop loss was placed at 137.15. Entry took place at 136.54, and the target was set at the support boundary at 135.94. So a target of 60 pips was set for this trade. And as you can see here on the trade result on this chart, the market declined as expected and provided us with a trading gain of 60 pips in just over 7 hours. So as you can see here, the market pulled back a little bit and then continued this movement bearish in response to the ABC signal that was given. Now, there were actually two choices that you had in terms of how you could have traded this. Depending on the risk to reward ratio that you have for your trading, you could have either entered the market as soon as the candle closed at this area here, or you could have waited until the market pulled back a little bit to get a smaller stop loss, which would provide you with a larger trading gain. So depending on the risk to reward ratio that you have for your trading, you could have used both options to get the risk to reward ratio that you actually prefer in terms of your trading. Now here you can see the live result as well on my FX Pro account, where the market provided us with this trading gain of 60 pips, in keeping with the theory of false consolidation breakup reversals. Now to something that is very important that affects all of us if we are not very careful, and this has to do with the temptation to monitor our trades. Now, this is something that is very common, and that is something that is a common habit when it comes to trading, because of how volatile the market is and how dangerous this currency trading activity is. Now, taking a look at this setup once again on my live account, just gonna zoom in here to show you the consequences of having this bad habit of monitoring our trades. Now, this was a signal that was closed here that provided us with the entry opportunity. Now, if you had entered the market and then closed the platform as I did, and then simply waited until the market hit our trading target, then you would not have been affected or tempted by the situation that took place as the market reversed temporarily. Now, as you can see, the market did not move sharply bearish immediately, but instead it pulled back a little bit before actually resuming the bearish movement. So if you had made the mistake, and I definitely think it's a mistake to monitor our trades, if you were tempted and made a mistake of monitoring your trades, then what would have happened here is that you would have seen as the market rallied and came halfway the distance of the bearish candle here. So your stop loss was at this area here, and you would have basically been seeing that the market was moving closer and closer to your stop loss. Now, whether you have a $1,000 account, a $5 account, or a $10,000 account, or even higher, money is money, and if it means something important to you, then you're going to be stressed, and your emotions are going to come into the situation as you see the market reversing against your position. So what normally happens is that once we start to feel the stress associated with this type of reversal taking place, in most cases, we're going to be tempted to either close the trade early to avoid the market stopping us out, or we would break our rules in terms of our stop loss placement and carry it down a little more in the hopes that if the market does in fact rally, we would not lose as much as we would have if we kept the stop loss at the original area. So there are several bad habits and bad decisions that we can make when it comes to trading the currency market if we make the mistake of always monitoring our trades after we have entered the market. So if you continue to do this on a regular basis, what you'll find happening is that you will continue to cut your trades short and you would minimize potential losses, but you'll also sabotage your profit potential as well. So over the long term, or even over the short term as well, you're basically going to be seeing your account stay at the same level and not moving in any particular direction, whether positive or negative. So you're just going to be breaking even and moving sideways without anything to show for your trading efforts. So that is why if you don't have a platform that allows you to set trade alerts, then find some other way of not monitoring your trade consistently, that aggressively. Perhaps setting a time frame of say 24 hours. So if your trade is gonna be completed within 24 hours, perhaps set a timeline of say checking your trade every 4 or 8 hours just to see if the trade is still open. So find a way to configure your trading platform so that when you open the trading platform, you do not actually see the charts nor the trading profit or loss, but you can actually see a tab that simply tells you that the trade is still open or not. So you can check that tab on a regular basis, on a 4-hour basis, and that would minimize the temptation of looking at your chart and causing you to make these bad decisions that will ultimately sabotage your long-term profitability. So that's it in terms of this trading example on the pound Japanese yen, in terms of how we trade false consolidation breakout reversals. As I said to you before, in most cases, the market will break out at the other end of the consolidation, but the more conservative approach in terms of a trading target is to exit your trade at the opposing boundary because of the possibility that the market could continue to move within consolidation before it actually breaks out at the other end of the consolidation. So these 5 challenges that we mentioned before in the video were basically solved in this trading example. Very important to be able to identify consolidation setups in the best way. And I know that there are 2 schools of thought in terms of how we draw resistance and support boundaries. Some people prefer or advocate for drawing these lines across the bodies of the candles, which will be drawn across the closing prices or the opening prices of the bearish and the bullish candles. But what I found over the years is that the market actually responds more accurately to the consolidation when you draw the lines to include the wicks of these candles as well. So that is very important. The ABC signal was a signal that was given, and the overall signal was strong enough, and it was also the type of signal that we generally associate and see when it comes to false consolidation breakout reversals. The stop loss was properly placed at the C of the ABC, which is always the best place to place your stop loss when it comes to these types of signals. So as you can see, our stop loss was never threatened by the temporary pullback that took place before the market actually resumed this movement bearish. The decision to exit at the support boundary was the best one, was a better decision, because in most cases the market will reverse and hit the opposing boundary, which in this case was the support boundary of the range consolidation setup. The pip target of 60 pips was well within the 50 to 70 pip range when it comes to my trading methodology, There are exceptions that are justified where the market does provide us with trading gains of less than 50 pips and more than 70 pips. But in most cases, we try to aim for a trading target of between 50 and 70 pips. And in this case, the pound Japanese yen provided us with that trading gain. The holding period that is set for most of my trades when it comes to trading on a 4-hour chart is 24 hours. And because of how aggressive this movement was on the pound Japanese yen, our trading target was hit well within that target holding period. In this case, it was hit after just 7 hours. So a very good trade that was made on the pound Japanese yen to provide us with a strong trading gain in a very short period of time that basically showed you exactly how to trade these false consolidation breakouts that can be very tricky when it comes to trading on the currency market. So as usual, if you have any questions, you can let me know by emailing me at shepherddwayne@gmail.com. You can also find me on Facebook and Baby Pips using the same username DRFX Trading, and on Twitter at Worldwide876. You can also check out my blog where I provide detailed analysis of trades like these at drfxtrading.blogspot.com, as well as on Instagram at drfxtradingboss, where you'll find my videos and other posts that I have with respect to my trading methodology. So as usual, until next time, happy trading.